Good morning, good afternoon, good evening, students. Whenever you are watching this is Mr. McRitchie with AP Macroeconomics Remote Learning Lectures, and this will be my lecture over the money market graph, one of the last handful of graphs we have to cover in AP Macroeconomics. Reminder that those graphs include the production possibilities curve, the aggregate demand and aggregate supply graph, the money market graph, and then a few more that we will cover in the next handful of weeks, including the loanable funds market graph, which we will cover this week as well. And then in later units, the Phillips curve and the Forex market. Now, today's market will have much to do with the money stuff we've been talking about these last few videos. So if you haven't watched the video over monetary policy or over money and interest rates, I recommend watching those videos before you watch this one, because I'm going to be referring back to things in those videos that will sort of help clarify things. But the video today will be over the money market graph, and we'll get started now. So, this lecture, this PowerPoint that I'm using, has my stuff for loanable funds market as well, and there's an extra comment that I need to fix in that. But we'll just start with the first part of this lecture today. I'll finish this other part up later. So, money market. So, just like any other market, so a market is where there is a supply and a demand for a thing. We mentioned that with just a regular old supply and demand graph, it was a market for a good. It could be like the market for bacon or the market for toast, and it's morning and I'm hungry, so that's why those words are coming out of my mouth right now. But there is also a market for money, the actual concept of money. There is a supply and a demand of it. There is a limited amount of it that exists, and we want it. Therefore, there is supply and demand. Now, the supply of money has actually been mentioned in a previous video. It's the money supply, and specifically when we're referring to the money supply with this graph, we are referring to M1. And then again, is the money held in the form of currency, so cash in our economy, as well as the money that is held in bank deposits. So basically, the money supply is all of the spendable money in our economy. It doesn't include things like money in a bond, because that's not spendable, or money in stocks, because again, that's not spendable money, or money held by the Federal Reserve, because you can't spend it. You don't have any access to that money. So that's be money that's held either in banks or in currency. So money that is accessible and spendable is the idea here. That's the money supply. There is also a demand for money, which you guys are probably aware of, at least the idea that there is demand for money, because oh boy, howdy, do you want money all the freaking time. But we'll get into what the money demand is and how it's a little bit different than what you're thinking. The last bit, when I'm looking at this graph, the thing that probably stands out the most to me is the y-axis, because I can get like supply of money, demand of money, quantity of money, that all tracks with all my graph stuff. The thing that is weird is this, that the nominal interest rate is the y-axis. Remember, on a supply and demand graph, the y-axis is the price, and this is where it gets kind of weird, because you have to think, what is the price of money? And you're like, more money? That wouldn't really help. That would make the graph even like more impossible to deal with. So we say, for the sake of the money market graph, that interest rates are the price of money, because when you're borrowing, interest rates are the price of borrowing, and when you're saving, you get paid with an interest rate. So that tells me that there is some sort of value on money, and that value is interest rates. So we're going to use interest rates as the price of money. That'll make a little more sense when we get to the money demand curve and how that line works, because that'll sort of help you understand the interest rate part of this. But we'll start with the money supply first, because that is, I think, the most important line on this graph. It's the one we mess with the most. So, the supply of money. The money supply, or the supply of money in this graph, is set by the Board of Governors of the Federal Reserve System, or the Fed. And it is controlled by monetary policy, meaning interest rates don't super matter to it. Like, interest rates being high does not mean that there is a larger amount of cash and money in banks in the economy, or a lower interest rate doesn't mean that there's less of those things, okay? It doesn't actually change that. So, because there is no relationship between the interest rate and the supply of money, it's a vertical line. It is set wherever the Federal Reserve determines that the total amount of cash and currency and money in banks is, and the Fed can change that through monetary policies that we've talked about in our last video, okay? Where things like an expansionary monetary policy increased the money supply. And oh, wait, guys, this is the money supply. So when we say it increases, that's actually a graph shift kind of thing. Now, just like previous graphs, this has an equilibrium point. That equilibrium point tells us what the current quantity of money in our system is, as well as what our current nominal interest rate is in general across the board. Now, again, different banks will offer you different interest rates, but there is sort of like a foundation level interest rate that our economy goes off of. That is set by this relationship. Now, changing the money supply, because when we're talking about graphs, you always got to know what changes it. What changes it? Short and sweet monetary policy. So if you did a good job in those notes, if you created a table of expansionary and contractionary policies, hell yeah, that'll be great. If not, now's a great time to make that table or make that chart, because here they are. Your expansionary policies are decreasing the reserve ratio, because that means banks can lend out more, thereby larger multiplier effect and more spending in our economy. So expansionary. The Federal Reserve buying bonds, because that means the Fed is giving actual cash to people and banks, so that's more money in the economy. And the Federal Reserve lowering the discount rate, because if the Fed lowers the discount rate, that means that banks can borrow from the Fed easier and cheaper, which means they will borrow more. And if banks have more money, then the money supply goes up, because again, the money supply is money in cash and money in banks. So, contractionary policy, if you were to increase the reserve ratio or discount rate, because in both of those cases, banks would have less money to lend out. And if they've got less money, the money supply is lower. And the Fed selling bonds, because if the Fed is selling, that means the public is buying. So I'm giving cash to the Fed for this piece of paper. That cash was in the money supply, but now that it's in the Fed's hands, it is no longer. And I have this bond, which doesn't contribute to the money supply. So the money supply goes down whenever the Fed sells and the public buys bonds. Cool. So these are the policies that will change the money supply. Now, what does that mean for my graph? So here is sort of your foundation of the graph. The billions of dollars is an example. You don't have to have the billions of dollars thing there. It's a typically normal number to see, but you don't have to write that part. But I would write and label it like this at the jump. We've got supply of money, demand of money. If you want to do SM and DM and QM, that is fine. Those are allowed abbreviations. Capital M is for money. That is okay. Interest rates, sometimes abbreviated as IR. I will never abbreviate my y-axis on this graph. In fact, I will also write the word nominal up here. If you don't write nominal, they infer that you mean nominal, but there are graphs where real interest rate is on the y-axis, so it's good to get in the habit of knowing that on this graph, it is the nominal, or regular, interest rate that we're talking about. IRE for equilibrium interest rate, QME for equilibrium quantity of money. So, example, Federal Reserve lowers the reserve requirement. What would happen on my money market graph? So, what I've got to think of first, you don't know what changes the demand curve, so you don't mess with that yet. I've got to think, okay, is this a monetary policy? Yes. Therefore, this will change the money supply. If the Federal Reserve is involved, it will change the money supply. So, let's think about it. The way we determine what happens to the money supply is if it's an expansionary or a contractionary monetary policy. So, this one, Federal Reserve lowers the reserve requirement. Quick, check your chart, check your table, or check your brain. Is this expansionary or contractionary? Check it. Okay, this is expansionary monetary policy. The reason why is because if they lower the reserve requirement, that would mean that banks don't have to hold on to as much of your money, meaning they can lend out more. And if you go back to the multiplier effect, the money multiplier from last week's videos, the logic there is that when banks lend out money, that money is then deposited in other banks and can be lent out again. The money supply can build and grow because of this extra activity. So money supply should increase because if the reserve requirement goes down, banks can lend out more money, increasing the money supply through that multiplier effect. This is sort of the, if they asked you to explain it on the AP exam, I would write this sentence right here. So money supply increases, that works the same way as any other graph we've done so far. So at this point in the class, you should be pretty used to shifting lines on a graph. I need to increase the supply curve. Okay, take that vertical line and shift it over to the right. That's going to bother me. That's our new money supply. Banks have more money, which would lead to a lower interest rate. The logic of that, there we go. The logic of that is if banks have more money to lend out, just like any business with their good, the more of it that exists, the lower the price ends up being. So if banks have more to lend out and we want to borrow the same as before, they would have to charge less for a loan for us to borrow, right? So as the money supply goes up, as banks have more to loan out, interest rates start to fall, which makes borrowing easier. That's the good thing with an expansionary monetary policy for me and you, everyday people. My students, who are mostly seniors in high school, should care a lot about this, namely because if you're going to have to get a student loan for college, the interest rate on that loan is an interest rate. So if I'm telling you a thing that lowers interest rates nationally, making your student loans cheaper, that's the thing I would be looking for in the news. Like, I'd be looking for stuff like this, where I'm like, okay, so I have to borrow for student loans. What's the Federal Reserve doing right now? Well, we're in a recession, so we need to be doing expansionary policies. So the Federal Reserve is doing everything in their power to have interest rates get lower and lower and lower. Hello, people who are about to go to college. That sounds sick. Them having lower interest rates on loans means that your college gets more affordable if you have to borrow to pay for it. That is good news. That is something you want to see. So things like this are actually helpful for everybody. Now, the demand curve. Let's get to that before I go into the bigger depth of what that borrowing might mean for us. So, here's the disclaimer, and this is an important thing to understand. The demand for money is not how badly you want money, because that would be infinite all of the time. If I just asked you, how much money do you like? I can give you whatever you want. How much do you want? You would be like, as much as humanly possible, Mr. McRitchie. I would take all of the money you could give me, however much you are allowed to give me, the highest number possible. That is what I would like. So that would lead me to believe the demand curve is like an infinite line that's only in space or whatever. It's not worth thinking about. That is not what the demand for money is. So this is the important thing. I would write this down. The demand money, let me move my camera over a little bit so this is easier to see. The demand for money is your desire to hold your assets, your total wealth, in the form of spendable money. And that is different. The logic being, you have a lot of things that make up your sort of portfolio, your wealth portfolio. That is not just things like stocks and bonds, which a lot of you as students don't have yet, because you don't have the ability to buy those necessarily. But it also includes your physical assets, your car, anything that you actually own and could sell is a part of your wealth. The demand for money is your desire to have spendable money as a larger and larger portion of your wealth. Basically, if you want to have more actual spendable money out of what you have, that would mean the demand for money is going up. So let's explain how this is a downward sloping line when it comes to interest rates. Okay, so if you understand, like, okay, it's my desire to have my stuff in the form of spendable money, how badly I want to, like, not have stocks and bonds and actually have money in my bank account that I can spend. So why is it downward sloping? This is sort of like the key thing with the demand curve. It's like, why is it downward sloping? It's usually easy to figure out because it's like lower prices, you would want to buy more stuff. Here it's different because it's interest rates, so it's a little more tricky. So here's the idea. It's based around the relationship between interest rates and your desire to spend. Or to have spendable money, sorry. The relationship between interest rates and your desire to have spendable money. So here's the logic. If interest rates are high, so let's say you're starting off at this and interest rates are higher, or about to be higher, or are going up. If interest rates went from 5% to 10%, I would rather have my wealth making me money in that concept. What I mean by that is I would be moving stuff from my checking account to my savings account. Because if interest rates are higher, I'm collecting a higher rate of return on that. If interest rates are going up, I'd like to buy some bonds. Because as I mentioned in last week's video over financial assets, when you buy a bond, it's with that interest rate. And the higher the interest rate, the more money you make off of it. So the idea here is, as interest rates are higher, you would rather have your money in the form of assets because they can make money off of that high interest rate. So the higher the interest rate, the less good it is to have your money as actual money. The better it is to have it in a financial asset, like a stock or a bond or a savings account. Conversely, if interest rates were to go down, it becomes less and less important for you to have assets. Like if there's a bond with like a 1% interest rate, that is probably not going to keep up with inflation, and it's not spendable money. I'd rather just have that money in my bank account. If my savings account had, or like it does, has a terribly low interest rate, I don't particularly care about having money in my savings account then. Most of you guys who are students probably have very little money in your bank accounts, so you typically have a very low savings account interest rate because they scale it based on how much money you have. So you have a lower interest rate, makes it less likely for you to have your money in your savings account. It's why many of you don't keep your money in your savings accounts as teenagers, because you don't have much of a need for it, because you don't have a lot of money there, so you don't collect really much interest off of it. So higher interest rates, the less you like to have actual spendable money, because assets make you more. Lower interest rates, the more likely you are to want to have spendable money, because you will actually benefit from having it there and won't benefit much from having it as an asset. I hope that makes sense. Now, how do we get the line to shift then? How do we change the demand for money? So, again, this is the portion of total assets you want to hold in the form of money. Here's an example of a thing that could change this. If price level goes up, inflation starts happening, everything starts getting more and more expensive. Well, imagine you're you, and let's say that you keep a 20 in your wallet at all times, $20 bill in your wallet at all times. If everything's getting more expensive, would you rather carry more or less cash on hand? Probably more. If I carried $20 around before and everything is like 5% more expensive, I might carry $25 around. Just for the sake of, buying the same stuff's going to be a little bit pricier. I'm going to want to have a little more cash on hand just in case. So the idea there is if price level goes up, your demand for money should go up because your desire to hold your wealth in spendable currency will go up. You're going to want to have more spendable money because you're going to need that money to buy the same stuff you were buying before. So if a scenario throws something at you that is going to make you want to have more of your assets in the form of cash, there are only a few things that can do this. Price level is one of them. That means your demand for money would go up. So everything's getting more expensive. I'd rather have more money. If everything got cheaper, if price level went down, then I wouldn't really care about having as much cash that I could spend. So my demand for money would fall. So here are the list of things that will shift your money demand. There's only really three. It's written like there's like 5 or 6, but there's really only 3 things. The first one is price level, or aggregate prices is a word they might throw at you. Because you'll need to have more spendable money if prices are higher, and you'll need to have less if prices are lower. That one tends to make sense for people. The second one is changes in income. And I wrote /GDP because when GDP goes up, income goes up. So be careful with that. But if income goes up, if you're making more money, you're going to want to have more spendable cash because people who make more money tend to buy more expensive things, make larger transactions, buy nicer cars, bigger homes, more homes, etc. When you're very wealthy, you tend to buy more things. So you need to have a little bit more spendable cash. So higher income, higher demand for money, lower income, lower demand for money. That part people tend to get freaked out about. We're like, wait, I'm making less money. Wouldn't I want to have more? It's like, no, if you have less money, you're buying cheaper stuff because you buy more inferior goods when you're poorer. So you'd actually have a lower desire for overall spendable money. You'd end up wanting a lower total amount of spendable money than before. That part is weird, logically. I get that. The third one is the rare one. So listen very carefully and write exactly what I wrote on the slide if you're taking notes. I would write exactly this. It is very specific changes in technology, and I would write the bullet underneath it, which is it has to be changes in technology that affect our ability or desire to carry money. Okay? It has to affect your desire to carry money or to have spendable money. There's only a few things that'll change that. An example would be an ATM. ATM has made it easier for you to get cash out, so the creation of the ATM increased the demand for money because it made it easier for you to have your money in your bank account or in cash, which are the ways that you have spendable money. Made it more accessible, made your money more accessible, so that increased the demand for money. A negative example would be like the creation of credit cards, because a credit card, to be clear, is a loan. So the creation of credit cards actually decreased your demand for money because you didn't need to have as much money on hand if you had a credit card. Sort of made up for the fact that you might not have money in your bank account that you could spend. So the creation of a credit card decreased the demand for money. Creation of an ATM increased it. A good sort of logic corollary would be things like Venmo and Cash App or Apple Pay right now. All of which I would say increase your demand for money because they all make it easier to spend. And they're not giving you lines of credit. They're just making using your money in your bank account easier. And again, that money in your bank account is spendable money. So if it's making spending easier using money that is actually in your bank account, that'll help your money demand. Okay, So here is probably the most important thing when it comes to the money market graph. In terms of its impact, in terms of its importance with the rest of the course, its connection to the things we have talked about so far in the class. This thing in red, you need to write down. And the things in green sort of help you understand it. Interest rates and investment spending have a locked-in inverse relationship. Reminder that investment spending is spending by businesses on themselves, and that interest rates are most commonly referred to as the price of a loan. That's what they're most tied into. So here's how this works. Interest rates are lower, businesses could borrow more, right? If interest rates are lower, borrowing gets easier. We mentioned that in a couple slides ago. So businesses could borrow more from banks and spend more on large-scale purchases, things like equipment and factory capital is what they're buying. The idea here is businesses are the ones that are the most active when it comes to borrowing because they make the largest purchases. Like you borrowing 20 grand to pay for college is cute, but a business might borrow $50 million to buy a huge plot of land and build a factory there. So that's a much larger scale purchase. It's a much more important economic purchase than what you did with your interest rates and saving and your student loans. So what we're saying here is that interest rates are much more tied to business spending than to consumers, partially because consumers don't borrow very often. You might be able to count on two hands the amount of loans you get, period, in your entire life. But businesses borrow on the regular. They got to do it a lot because it's how they pay for growth and economic growth. So when interest rates are low, businesses spend more. Important thing to remember, last unit, investment spending is a critical concept in that it is a component of GDP. This means that interest rates changing will affect our GDP because it'll affect a component of it. And more importantly, graphically, investment spending is a shifter of aggregate demand. It's the I in CIGXN, which are our list of shifters for aggregate demand. So whenever our interest rate changes, our investment spending will change, which will shift our aggregate demand curve. Now look back on your notes from this PowerPoint. Every time we changed anything on our money market graph, our new equilibrium gave us a new interest rate because the y-axis is interest rate. If I shifted anything on this, it changed interest rates, which means it'll actually also change aggregate demand. This is the first time you will have experienced something that I refer to as a multiple graph shift. A problem that will cause a shift on more than one of our graphs because our graphs are connected. The things we're talking about in macroeconomics are things that affect the whole economy. So if we've got graphs of different sort of parts of the whole economy we're looking at, they're bound to be related in some way, shape, or form. So here's an example of how this might work. So I would, on your notes, draw actually two graphs. On this slide, it only has the money market graph, but I would draw a money market graph and an aggregate demand, aggregate supply graph. You don't need to have LRAS on there for now. We don't need to worry about that yet. But draw an aggregate demand supply graph as well as this money market graph. These numbers are just examples. You don't have to worry too much about the numbers. They're just there to give you like a reference point. So let's say there's an increase in the money supply, an expansionary monetary policy. So here's the logic of what's happening. Money supply goes up, interest rates go down because banks can now, let's just say banks have more money to lend. Actually, I actually need to change that. Let me literally change that right now. That is a typo. That is bad. Good. That's fixed on that slide. It's on that slide. There's just a typo on that one slide. Great. Sorry. That is actually a huge problem if you wrote that down exactly what I had there. So if the Fed increases the money supply, interest rates will fall because banks now have more money to lend and can charge less for those loans. They would also not need as much money saved in savings accounts because they have more money, so they would give you less money back for your savings accounts. So the price of money will fall if banks have more money because the more of a supply of a thing exists, the lower the price gets. That's kind of the logic. So how does this affect aggregate demand? Here is sort of the connecting the dots logic. We increase the money supply. Check. That leads to a lower interest rate. Check. Go back to the thing you just wrote down. Lower interest rates should lead to what change in investment spending? If interest rates are lower, what's going to happen to borrowing? It'll go up. People will borrow more and spend more. So investment spending will go up. And if investment spending goes up, what happens on our aggregate demand supply curve? AD goes up. So, there is a connect the dots element here. I will tell you now that this sort of opens a Pandora's box for us when it comes to this class. This allows us to do FRQs, namely, that will have you draw multiple graphs. You'll draw a money supply graph or money market graph. They'll ask you about an expansionary, contractionary monetary policy. You draw it, you write what happens, why you know that happens. Then they ask, okay, cool, what happens on the aggregate demand and aggregate supply graph? Draw that. So you're going to be taking the results of your initial shift and using them to tell you what happens on this other graph. So it's really important to, I would write down each of these steps and sort of circle these middle two, because this is what connects it. This is how we get the increased money supply to increase AD. This is why an expansionary monetary policy increases AD. I mentioned that when we talked about the monetary policies, that these things end up doing the same thing as a fiscal policy does. Increasing government spending is an expansionary fiscal policy. It leads to an increase in aggregate demand. This is an expansionary monetary policy in action. It also results in an increase in aggregate demand. But I mentioned at the time, monetary policies are more complicated. And this is what I meant by that. That there are multiple steps that get us from this weird thing you had never heard of, changing overall spending levels in our economy. Okay? Here is a different example. See if you can go through this one on your own. Decrease the money supply. What happens to AD? Go through the 4-part logic of what happens to the money supply, interest rates, investment, and then aggregate demand. Follow that logic yourself real quick. Pause it and do it real quick. Feel free to use the logic from the previous slide to help you out, from the previous 30 seconds to help you out. And unpause. So, if the money supply decreases, banks will start charging more for loans now because they have less money to lend out. It's become more scarce. So they're going to start charging more for loans, and they're going to offer a higher rate on a savings account because now they want you to store more money there because they have less money. So that higher interest rate, how will that affect aggregate demand? Well, decrease the money supply, which leads to a higher interest rate. That's the first part. This higher interest rates means that people will be borrowing and spending less. So decrease investment spending. There's less spending going on in our economy because interest rates are higher. And if investment goes down, AD drops. Because investment is one of the components of aggregate demand. Again, those were C, consumer spending, I, investment spending, G, government spending, and XN, net exports. So we have less investment, means we got less AD. There you go. And if we change money demand, this also affects interest rates, so changing anything on this graph could do it. If we had an increase in income, say there was an increase in overall productivity that led to incomes going up nationally, what would happen to money demand? Well, if we're making more money, we're going to be spending more money, so demand for money goes up. If I want to hold on to more of my money in the form of cash, then banks will have less to loan out to people, so interest rates will go up. Basically, if I want to have more cash on hand, there's going to be a little bit less in the banks to do stuff with, so they're up at a higher interest rate. Increase the money demand leads to a higher interest rate. You could also think of this as people want more money, banks will charge more for that money, is the idea. You could think of it like that. It's let loans get more expensive because people want to spend more, is kind of the thing to think about. But that increase in interest rate decreases investment spending, which would actually decrease a component of aggregate demand. This is important to mention because this will sort of your answer to these questions will be determined by how they ask it. What I mean by that, an increase in income should lead to an increase in spending, right? If they just said income increases, what happens to AD, you should just say that AD goes up. But if they say what happens to AD due to the change in interest rates based on an increase in income and how it affects the money market graph, you would say that AD goes down. That is tricky as hell. You've got to be very careful with how they word the questions and answer it based on how they word it. If they're mentioning interest rates at all, your frame of reference has to jump to the interest rates investment are inversely related. What the hell is happening to interest rates here? You got to figure that out. So you're basing your answer on what the question is actually asking about, because there are so many interconnected things in econ that asking a question like what happens to aggregate demand if income goes up could have two different answers based on what they're asking about. So be very careful for that. Okay. Last bit. Here are some practice ones for yourself if you want to just practice how these work. Draw what happens on the money market graph and then mention what happens to aggregate demand. Because we're all going to change AD. This is all an aggregate demand shift. Aggregate supply is not moving here. This is not an aggregate supply thing. This is all aggregate demand stuff. So draw what happens on your money market graph first, and then maybe just do a quick little write-off to the side of, oh, AD would go up because interest rates did blank. That's a good way to do it. Okay, so pause the video, answer those questions, and unpause it, and I'm going to go through them. I'm not going to draw all of these. I'm just going to talk my way through it. Okay. Unpause. It's me solving them now. The Federal Reserve lowers the reserve requirement. Okay, lowering the reserve requirement, I have to think for what happens to the money market graph. If it's a monetary policy, it changes the supply curve. Okay, so it's a monetary policy, so money supply will be changed. Federal Reserve lowers the reserve requirement. Will the money supply go up or down? Well, if banks can loan out more of my money, they can give more people more money, and more sounds like more, so I'm going to go with it increases the money supply. So for number one, I actually need my pen again. I literally always forget to have this pen thing open when I'm doing my first video each day. Every time I forget to have the pen open. It's the one thing you can count on in these videos, other than me talking way too fast. So this will increase the supply of money. What will happen to the aggregate demand aggregate supply curve? If the money supply goes up, interest rates fall, so aggregate demand will rise. Because if interest rates are lower, we can borrow and spend more, so AD goes up a lot. Fed raises the discount rate. Okay, I know it's Fed, so I know it's a money supply thing. I know it's money supply because it's a monetary policy. Those are always money supply changes. Got to think if it's expansionary or contractionary. Raising the discount rate means it is harder for banks to loan out money because banks will have to pay more if they want to borrow from the Fed, so they'll have less money on hand. Basically, is this a good or a bad thing? This is bad. This will make it harder for banks to loan, so supply of money goes down. If the money supply decreases, my interest rate will go up, which means that AD will go down. Supply curve goes down, interest rates go up, AD goes down. If you're not sure how this causes this, how the money supply thing changes the interest rate, check your graph. Don't be afraid to draw it. You're not used to these yet. Don't be afraid to draw them. It says to draw them here. I'm not, because I would have to open up new slide tabs and spend 15 minutes doing these as opposed to 5. But draw them. They'll help you understand it. If banks have less money to lend, they would charge more for loans, is the logic. Banks have less to lend because money supply is going down, so loans get more expensive, so we borrow and spend less. That's the idea. The Fed buys bonds. I again see the Fed, I see the Federal Reserve here. Those tell me it's a money supply change. So this is a supply curve thing, supply of money. The Fed buying bonds. This is expansionary or contractionary. Time to do big brain thinking stuff. If the Fed's buying bonds, where's the money going? They're buying bonds, so the money has to be going from the Fed to whoever has the bonds. Well, the open market is where the Fed, banks, and consumers and businesses all buy bonds at. So if the Fed's buying them, then banks, businesses, and consumers are getting that money. But it's going from the Fed to those groups. That means there is more money in the economy. Supply curve is going up, which will lead to a lower interest rates because now banks will end up with more money because the Fed just gave the money for their bonds, so the banks have more cash on hand. You can see Archer in the background on the couch. What a good dog. Hey, Bobo. Oh, he just walked past. Now you can't see him. That sucks. Okay, interest rates go down, so AD goes up because if interest rates are lower, we can borrow and spend more. These two, interest rates and aggregate demand, are inversely related because interest rates and investment spending are inversely related. That's how these two are inverse. Incomes drop nationally. I don't see the word Federal Reserve here. This is not a monetary policy. This will not change my supply curve. Same with this one. This is not a monetary policy either. Neither of these things are done by the Federal Reserve. Federal Reserve doesn't control income. That would be insane. Federal Reserve doesn't control the price level. That would be insane. They only control these three things. required reserve ratio, discount rate, and this open market operation. So these two are demand of money shifters. And again, income and price level are both demand for money shifters. So incomes drop nationally. Will people need to have more or less cash on hand if they're making less money? Well, if I'm making less money, I'm buying cheaper stuff. I would be buying lower priced products. If I had less money, I wouldn't be carrying around 20 bucks in my pocket. I'd be carrying around 10. So I'd have less of a demand for money. If I draw that on my money market graph, a decrease in demand for money will lead to a lower interest rate. Because if I don't want money as bad, I'm not likely to borrow as much. And that would mean for a bank, oh crap, we need to charge them less because they don't really want to borrow right now. We need to make it a better deal for them to get them to do that. So interest rate would go down, and based on the change in interest rates, this is the important thing, based on the change in interest rates, aggregate demand would go up. For you to answer this question fully, it would depend on what they phrased this as. This is a little too vague of a phrasing for you to be able to really answer for this part accurately. It would have to say, as a result of the change in interest rates in these problems, for you to really concretely say, this is what's happening. For the last one, demand for money should be going up, because if price level is higher, I'm going to need more money to buy stuff. If demand for money goes up, interest rates go up. Should mean that aggregate demand falls because borrowing gets more expensive and we cannot borrow as much money. That is the idea for the money market graph, that a shift on this graph will change interest rates in our economy, which might not have mattered to you prior to today, but hopefully you see the importance of it now, where changing interest rates changes our ability to borrow and therefore our ability to spend. Because if we're not spending, that hurts our economy. So when interest rates go down, it ramps up our spending, that ramps up AD, and that would be good. Okay. I believe that is all I have to cover with the money market. Let me double check my PowerPoint. Yeah, that's it. If you need quicker refreshers than watching this 37-minute, oh god, didn't mean for it to be that long, 37-minute video, I would recommend using the ACDC economics videos. That guy does a pretty good job of keeping them concise and between 5 and 10 minutes of like reviewing a topic as opposed to teaching it for the first time. Whereas my stuff is all about teaching you the thing for the first time, which usually has to be like a full lecture for it to really make sense. So again, be aware of what's happening to that graph, that if it's a monetary policy, it changes the money supply. If it is not a monetary policy, if it's a thing like income or price level or a super specific technological change, that could affect the demand for money. So be careful with that. But that is it for today's video. Thank you all very much. I wish you the best of luck going forward. If you've got questions, leave them in the comments section of the video. I'll get around to them best I can. But thank you guys. Have a good one.